The market has been very enthusiastic this week ahead of Wednesday's Fed meeting, with investors pricing in basically a 100% chance of a cut. What are the options market seeing ahead of that meeting? Joining us now is Chris Murphy, co-head of derivative strategy at Susquehanna. Chris, great to have you with us.
Thank you. Good to be here.
So how are investors positioning?
I think everyone's long. I mean, we're going to be highlighting to our clients that we're seeing a lot of put spread buying, kind of focused on the September 30th timeframe. It is the second half of September, still does have some weak seasonality. But the truth is, I think you can feel comfortable being in this market at all-time highs, heading into an event with some question marks. People are wondering, hawkish cut or sell the news, things like that. But if you have some of these put spreads on in macro products like Spider, Qs, like we've been seeing, you can feel more comfortable going into that event, staying long.
Yeah, certainly volatility remaining low has been helpful to this rally, to say the least. In terms of particular sectors, I mean, tech was a big winner this week. I'm assuming you saw commensurate flows there. Are you seeing some bullish activity looking out beyond September in tech?
Well, yes. Okay. I mean, I think that in the Mag 7, we hear so much talk about the market widening out and trying different sectors, things like that. The reality is the Mag 7 continue to work really well. And, if you are, once again, long or you want to add some exposure, you might want to look at a call spread. If you're looking at the options market, call spreads are setting up better now in some of those names because people really want extreme upside. And when you buy a call spread, you take advantage of that desire for extreme upside. So we've seen some notable call spreads out at year end for Amazon, Google, and a couple other ones.
This idea of staying invested and then perhaps taking advantage of low-cost hedges, it makes a lot of sense. It sort of speaks to a sustainable type move higher. I wonder if you're seeing any evidence as we get closer to the fourth quarter of sort of chasing, or people just trying to really grab some upside optionality in either sectors or, the China market or anything like that.
I mean, you just led me into it. The China market, for sure. That's an example. I mean, especially this week. Obviously, you can look at the underlying ETFs, and they are ripping, but it's just incredibly consistent call spread buyers in K-Web, in A-shares. Another example of, because there's such an extreme demand for upside, those call spreads set up really well for investors who want to play that into the year end, or really, a lot of it seems to be focused on November timeframe. We have the tariff deadline. There's some positive kind of, headlines here and there. So people are really playing one more leg higher on some sort of deal, taking those stocks.
Just going to the flip side, Chris, where are you seeing sort of the most hedging activity, areas where investors might feel cautious about the gains?
Consumer restaurant names, Sweet Green comes to mind. I have 4 daughters. Taking them to Sweet Green is pretty expensive. If things start to get even more expensive, that's one that had some consistent bearish flow. Even Chipotle, every single day, put buying. Now, I would say those stocks have been hit really hard. Just recently, we started to see, we saw a call buyer in January in Sweet Green, maybe trying to pick the bottom. And then in Chipotle, end of October, put sale, once again, kind of saying these things have gotten killed. We're going to kind of dip our toe in. But up until just recently, those have been under fire.